right. Good afternoon, everyone. My name is Jill McCall. I'm the director at the Loyola University Chicago Family Business Center. We are so excited to be here with you today. We are introducing one of our strategic partners, BDO. BDO is with us, and we thank you so much for engaging with us this way. Mike Dean is here to give you perspective on our presenters who are here to talk about inflation's persistence, monetary policy against the backdrop of a looming recession. Hopefully not all gloom and doom, right?
That's right. Thank you, Jill. Appreciate it. We're very excited and grateful to be entering our second year in partnership with the center and with you and your team. And we're very, very happy to be a resource for you. What I would like to do is introduce my colleague, Mark Biegel. Mark is the national leader of the BDO Wealth Advisory Group. As you can see from his bio, he is an accomplished and very well-credentialed wealth advisor. And we'll be spending the next 45 minutes hearing remarks from Mark on what he's seeing in the state of the economy. From a logistical standpoint, we will set some time aside at the end for questions. And so if any occur to you as you're listening along, feel free to drop those into the chat and we'll keep tabs and try to address as many as we can. And the presentation is being recorded. Both the recording and the slides will be made available to you after the presentation. So with that, Mark, I would like to turn things over to you, my friend.
Michael, thank you for that kind introduction. Jill, thank you for having us today. And what you'll learn very briefly is both Matt and I are analysts. We've been analysts for we're in our third decade. Let me take 2 seconds to introduce Matt, who I've worked with for 15 years. Matt is a CFA, he's a Duke undergrad, Wharton MBA, did a 3-year stint in healthcare investment banking in New York, worked in the venture hedge fund for a decade, did a year in private equity, and we've been together for the last 15 years. So with that, let's get started. So what are we going to cover today? We're going to cover inflation and the central bank's policy response, current economic data, the recent banking crisis under the construct of securities held to maturity, a quick financial market update, current opportunities in today's environment, and then we'll open it up for questions at the end. So let's start with what is inflation, what caused it? I think we all know inflation is an economic phenomenon when the prices for services and goods rise. So what's transpired in the last couple of years? We had massive fiscal response related to COVID. We'll unpack that in the next coming slides. Our Federal Reserve massively increased money supply and engaged in another round of quantitative easing, which we'll get into on another slide. COVID caused a robust supply chain disruption. And then we'll talk about kind of geopolitical shifts, deglobalization, and what that means for its impact on inflation. So as we step back and we look at what happened during COVID and shortly thereafter, our government produced many programs with stimulus, fiscal stimulus of $6.1 trillion. These are all listed for you. You can see the different programs. But to compare and contrast that, in the greater financial crisis, fiscal stimulus was $750 billion. So massive amounts of money were poured into the system. Additionally, our Federal Reserve ramped up money supply rather dramatically, and only till recently, when they started to hike rates, that trend has gone the other way. Matt, you want to take this one?
Yeah. So another really significant phenomenon that occurred from COVID is consumers and businesses alike took the money that they received and pretty much had excess demand for every goods and services imaginable, as most of you are well aware. This was at the same time that we had goods and services, supply chains being disrupted, whether it was less labor or more difficulty producing goods, particular goods. That really sent us to many decade-wide levels of imbalances between customer inventories and backlog of orders. And we saw several years with a significant supply demand mismatch. That's kind of come back together towards the end of last year and certainly at the beginning of this year, which hopefully will eventually ease some of the troubles with economics. But this is really economics 101, thinking back to your school days. Supply demand, if they're out of whack, prices will rise.
Continuing geopolitical landscape.
Yeah. And then at the same time as all that was happening, there were additional disruptions around the world. Some of them really predate COVID, beginning with new tariffs between China and the U.S. under the early Trump administration days, including sanctions, COVID-19, for those that were closely following. Obviously, a lot of goods and services come out of China. For many years, China had a COVID-19 zero tolerance policy, which further disrupted their supply chain as well. All of this was further exacerbated by Russia's invasion of Ukraine, huge disruptions in the commodity supply chain. Some of those have come back down, energy in particular, which saw an initial surge where WTI was energy prices were ultimately over $120 a barrel. It's come back down quite a bit, but we've seen, generally speaking, prices come back down a little from the initial. And then ongoing tensions in the Middle East continue. OPEC, which still largely controls a lot of the global oil supply, has recently once again cut output.
So let's step back and take a look at the consumer price index and what transpired pre-COVID, post-COVID. Where are we today? So with all of that fiscal and monetary stimulus, inflation, which was hovering, plus or minus between 1% and 2% for quite some time, spiked last summer to 9%. And recently it dropped, and I think the reports yesterday were at 5 and change. And so it's coming down, but to keep the kind of this in context, the stated objective, and we'll get into the mandate of the Federal Reserve, but they would like to see a 2%, inflation rate. So things went crazy. We'll get to unpack, what's driving those numbers. So the index is broken down in 4 major components: services, good, food, and energy. In services, as we get to the next slide, you'll see the concept of homeowners equivalent rent. So housing prices skyrocketed, correspondingly rents took off, and that is 1/3 of CPI, and it's 65% of the services component of this index. Matt, we just switch to the next slide. So since COVID, there was a massive price spike in housing, and rents really took off. And so the Fed is trying to arrest housing prices to control the shelter index, which is a homeowners equivalent rent, concept. And that's really still moving forward, but it's coming down. It's a lagging indicator, but this is what the Fed is having to fight. So they're dealing with labor and they're dealing with really housing, and they'd love to see, unemployment spike, and they'd love to see housing prices arrest. So this speaks to the massive undersupply of housing, which is why inflation may be a little stickier. So household formation has moved up drastically since 2010, yet construction has not kept pace. And today, our estimates are we're 3 to 5 million units short in the US for housing, which is causing the issues the Fed is trying to deal with. Inflation is not a US problem. It's a global phenomenon. So I'll let you take a look, and we'll pause here for a second and just take a look at what things look like in Sweden, United Kingdom, and Germany. They're all measured differently, but clearly for the Europeans, energy is a larger percentage of their respective inflation gauges. All right, so let's step back and talk about what's the goal of the Federal Reserve. And it's a dual mandate. It's price stability and it's employment. So what we can see here is this was last month, inflation's reading was 5%, and the goal is 2%, and unemployment at 3.6 is certainly below target. So this is why the Fed is undergoing current policy to get this back into balance. So Matt, you want to take this?
So with one box checked of the two mandates that they have, unemployment being full, they need to really aggressively attack inflation, price stability. And what they've done is they set out from an extremely low base. Obviously, we were very close to zero during most of COVID. What they've done is they've set about on the most aggressive and quickest Fed tightening policy in modern history. The dotted graph here, the dotted part of this graph, shows that in just 13 months, we're up nearly 500 basis points, 5%, effectively from 0 to roughly 5% today. And this has some of the prior tightening cycles at the Fed and how long it took to get there. As you might imagine, and what we're going to talk about over the next couple of slides, is this very rapid tightening and the speed and the scope of what happened has caused disruptions in the economy in many different ways. And we're going to get to that in a second.
So I'll take this one. And this is, we'll back up and talk about the Fed expanding the balance sheet when this came into vogue. So as we all remember, in March 9th of 2009, our then former Treasury Secretary, Ben Bernanke, basically engaged in quantitative easing. In English, the left hand of the government prints the money, the right hand buys the money, and it keeps rates artificially low. And when you do that, when rates are artificially low, it drives valuation. And we'll talk about this a little bit. The lower the rate, the higher the valuation. And so you create a wealth effect, which has a corresponding consumption effect. So that's how we got out of the greater financial crisis. The Fed engaged heavily in the same strategy back in COVID and expanded the balance sheet rather dramatically. And the red component here is buying United States treasuries, and the green component is buying mortgage-backed securities. So what the goal of the Fed, has let the market know is that they would like to see 2.2 trillion run off over the next few years. And our estimation, that's another equivalent to 25 to 75 basis point rate hikes. Recently, there was a little reversal in this as a result of the financial crisis. They are now letting people go to the window at par, and I'll explain what that means in a few slides. Matt, anything to add?
No, I think you said it well. Yeah. The other thing to note is, as we said, inflation is a global problem. We've seen the exact same thing from other central banks across the world. The vast majority of major central banks have also raised rates substantially over the last year. This has a list of where most of the nations and their central banks have gone, and this is their effort to, of course, fight global inflation.
This is really important. We're going to talk about healthy common sense. We know the yield curve is inverted, and we'll talk about what that means. So currently, the short end of the curve, 3 to 6 months, is hovering around 5%. And you can see as you go out, you go below 4% for a 10-year. And why this is important, we have to remind ourselves of the banking system. Our banks borrow short and lend long. So banks are disincentivized to lend when you have a yield curve inversion. I think there's been 12 yield curve inversions over the last 50 years and 8 recessions. And I think we'll get to the next slide to remind us that credit is the lifeblood of the U.S. economy. And when you remove it, what a surprise, you have slower economic conditions, 12 to 24 months out. So again, we discussed credit's the lifeblood of the U.S. economy. When the yield curve is inverted, it makes it more difficult for banks to make money on loans. And again, not a surprise, healthy common sense, when you slow the pace of lending, you reduce economic activity on a prospective basis. Matt, why don't you address these items?
When we think about where we are now and where we might be going, there are lots of economic data points. We're going to talk about a bunch of them in the next several slides But it's important to know that many of these are lagging. Federal Reserve knows they're lagging. The markets know they're lagging. Things like inflation, as Mark said earlier when we were discussing house prices in terms of homeowners equivalent rent, that's a lagging indicator. It's telling us what happened. Not everyone renews their rents on the same day. Usually it takes place over a year. So it's giving us a little bit of a history versus where the future is going. Coincidental indicators are things that are occurring right now in real time, payrolls, industrial production being two of them, and then leading indicators, certain parts of the housing data and new business orders are some of those. We're obviously paying a lot of attention to the leading indicators to give us further direction of where we might be heading. So this graph here is the top part of this graph is lagging data. And as you can see, the lagging data is very strong. And if you do not know what you're looking at as an investor, you might look at some of the data points and say, things are still pretty strong. If you're looking forward and looking at some of the leading indicators, exact opposite picture, where things have really weakened up quite a bit. It's probably why the market expectations are for where rates are headed are where they are. And we're going to hit that in a little bit as well.
So as Matt said, certainly with the rising rates, leading indicators like housing are under, their recent average, and we suspect heading further south. And so this exacerbates the problem the Fed's trying to deal with. We don't have enough housing in the US. We're raising rates, housing starts are denigrating. So we are exacerbating the problem and pushing it out.
And this is another key metric which many look at, which is new orders in one of the particular readings, ISM manufacturing. And 50 is generally expanding, the point at where we're expanding or contracting. And we've been below 50 for quite some time and still comfortably below 50, implying that the economy is slowing and weakening. And as we're talking about, housing has become a major issue. We know housing cannot go up 20% per year. That is not healthy for the economy. May feel good as a homeowner, but not something that we want to see. The Fed certainly doesn't want to see that. And when you have mortgage rates, which are going to be in an upcoming slide, skyrocketing from 3% to 7%, that certainly puts a crimp on consumers. In addition, prices have yet to reset lower. That probably is coming. We don't really know in advance where housing prices are going, but the combination of housing prices essentially being where they were and a heavy mortgage makes home prices highly unaffordable compared to where they were and likely tells us where we're headed. And here's just the graph of the 30-year mortgage. You can see last couple of years we were near 3%. Closing in on 7%. We've been roughly at 7% for roughly a year.
So let's step back. I think what we're trying to convey is there's been a reduction in liquidity by the Fed, and then the recent phenomenon in the banking system is a further reduction in the Fed. And as you all know, Signature, Silicon Valley Bank, and one other smaller bank, regional bank, have declared bankruptcy, and we're working through the process. And you'll see in the next slide that Silicon Valley Bank, we'll get to the disclosure about what they held to maturity and what the losses were in their treasury book. But this was one, they had a very concentrated deposit base in the venture capital community. So big private equity firms like Code2, Tiger Global were telling their portfolio companies, pull your cash in your credit lines quickly before the banks cut you off. And, there was some Twitter scares and cell phones. So a year ago, or even 4 months ago, and you'll see in KPMG's most recent disclosure, the bank was reasonably healthy, and I'll explain, what transpired. So this is a lot about, cell phones and Twitter, as much as poor duration in constructing their treasury portfolio. So what happens, you can see the unqualified opinion by KPMG, and this is not to denigrate KPMG. KPMG is an outstanding firm. But what happened here is that they had, at the end of the year, $15 billion of securities that were held to maturity, 15 billion of losses for securities held to maturity, and they had $16 billion of equity base. Now, the securities that were marked were treasuries. They got a phenomenal amount of deposits in the last 2 years. They went from 65 billion to 195 billion, and they were taking those monies, they're buying treasury securities at the time at 50 basis points, 100 basis points. Rates spiked in the 10-year to 4%. So they're huge, mark-to-market losses. And we relaxed our mark-to-market provisions after 08. So there's a footnote disclosure saying what it is, but the expectation is that they were going to hold these to maturity and they would have matured out at par. But given the run on the bank, they were forced to liquidate these securities to meet the needs of depositors. So the CCAR, which is the Comprehensive Capital Analysis Review, is the bank stress tests. They occur twice a year. And shockingly, the stress tests didn't have a scenario with a rapid rising rate environment like this. And so, they were a little bit of a victim of circumstances, and they were going to try to raise capital. And today our news cycle is 24/7, and Twitter and the iPhone helped, proliferate Silicon Valley's demise. And just one point on Signature Bank, Dodd-Frank, one of the co-authors of that bill, was on Signature Bank's board. And it's not to denigrate that, senator. It's just to suggest that it's important to understand your deposit base. And there was an assumption that all these regional banks made that they could get capital anytime.
And I would just harken back to the slide we showed you earlier with the dotted graph showing the speed of which rates rose. That point which we made earlier, that's really why this happened. It happened so quickly. Treasuries took a hit, pricing went down. You had these unrecognized losses, and in a couple of cases, like Silicon Valley, that was forced to realize the losses because of the flight of depositors. And yeah, it was right on cue. This is a phenomenon that many of us are experiencing. Certainly, our business, for one, we've been seeing an inflow of cash that is coming from the banking system, where the banks are still largely paying zero or very close to zero in interest, and we're able to turn around and put that capital to work and buy 5% treasuries. That's what's happened. This graph here, this is actually showing 3-month money market yields, and you could see 3-month money market yields are they got over 4% late in the fourth quarter of last year, whereas the FDIC national savings rate is still below 0.5%. This is just math. It's just an arbitrage, even for the average consumer. And this was really the beginning of why this happened. And then the issues were obviously compounded by, as Mark said, Twitter and cell phones and things like that.
I think Matt said it would stay with your cell phone, billions from your bank to your brokerage account, and that's exactly what's transpiring.
And this is just to show the proliferation of those money market funds. The total amount in money market funds has really skyrocketed in the first quarter. This is a really, really significant move in a very short period of time. This is almost entirely coming from bank deposits.
So what's happening, and by the way, JP Morgan and Citi report tomorrow morning, what's happening is deposits have fled smaller institutions and gone to larger institutions. This is exactly the opposite of what the Federal Reserve would like to see. So there are winners and losers. And tomorrow morning, my guess is JP Morgan's numbers come out at 7:30 or 8, and you'll see that they picked up the vast majority of these deposits fleeing from one bank to another. And you can see the other recipients in order are Morgan Stanley, Bank of America, and so forth. Bank of America reports next Monday, but we will glean from the banks that start to report next week, both money centers and regional, what the impact of the March events were. Want to talk about money centers?
Yeah, the ultimate impact on this is going to end up being tighter lending standards, and this will end up being a tighter economy overall. We're already seeing it. Sentiment, even at the tier one or the tier one banks, systemically important. We're seeing some tighter lending standards. You're seeing the banking system a little bit lock up in terms of new loans, and that is, as Mark said earlier, credit is the lifeblood of the economy, and if that gets tighter and stricter, largely because bank balance sheets have weakened, we're going to see this tighten and eventually slow the economy.
So the recession probabilities are growing, and our former Treasury Secretary Lawrence Summers, basically states the fact that since 1950, anytime unemployment's below 4% and inflation's above 5%, we always have a recession, within the following 2 years.
So just a really high level point here is policy decisions by the Federal Reserve, even Congress, they always act with a lag. And there's some sectors that are, if the Fed raises rates tomorrow, we will immediately see prime and SOFR, used to be LIBOR, we will see those move up. But most policy does act with a very lengthy period of lag. The consumer balance sheets still are fine, but we would expect everything will weaken somewhat as these higher interest rates really take effect.
And one other point is that credit card debt from consumers are at their all-time highs. So if things weaken up, that may suggest some other future problems for the economy.
Same thing with businesses. You're seeing that cash per share has been declining over a long period of time. The last tick up is cash per share has increased, and the net debt to EBITDA numbers, more debt per cash flow over time as well. So we got to watch for business, obviously corporate, where we'll get a good earnings, as Mark said, earnings start this week and continues for another 3 weeks, 4 weeks or so, and we'll get some good color on that.
And this is, you may ask why this belong here. There's the Atlanta Fed produces something called GDP Now, which every time there's an economic change, they update their forecasts almost in real time. And so this is a few days ago. And what they're suggesting is there's 2% growth for the first quarter. Both January and February were actually pretty strong, and then March starts to roll over. So we expect things to weaken, but we're not there yet. And the bulk of this is more a lagging data point, and this will be coming out, shortly.
So just a quick summary on the economic part, we'll move to the markets in a second. But really, COVID-19 and everything that occurred, really unprecedented stimulus, really hit the supply chains hard, really caused excessive inflation that we haven't seen in many decades. That response was elicited a very, very aggressive response from central banks really around the world. That the rapid shift in monetary policy is really causing disruption with certain sectors like the banking sector. We didn't talk about autos, but you're starting to see that in the auto space. Some of these areas are really being impacted by this dramatic increase, as we discussed. And the U.S. economy broadly has grown. Inflation still too high, though. Maybe a buffer in the unemployment world. But the Federal Reserve consensus likely that they're going to keep rates higher for long.
So let's start with the bond market and what this slide is telling us. This slide is telling us market participants believe that the Treasury rates will drop, and they're the blue dotted line. And then we have the majority of the Fed, the average of the Fed governors is the red line. What you can see is the Fed is substantially higher than the market, and they continue to let the market know rates are going to be higher for longer. The staffers at the Federal Reserve's view is their biggest issue is that they stop and they ease too soon and inflation comes roaring back. Right now, that's their biggest fear, and yet the market has a different view. And what this is a schedule showing what the expectations are for Fed action. So as of May, the market is expecting as of May 3rd to get there's a 73% probability that we'll get a 25 basis point hike. This increased rather dramatically after last Friday's unemployment report was much stronger than anticipated. That number was 38% probability for May until Friday's unemployment report. So this moves all over, but just giving a sense for then the market thinks we're going to go from a peak rate of 5 down to 4 by January of 2024. And the Fed is indicating to the market that is just not what's going to happen. So our view is, fighting the Fed is a difficult endeavor. And we think the market is a little premature in their thinking. Matt, anything to add?
This has probably been the area that markets, everyone likes to pay attention to equities and the volatility, but the bond market has been where all of the volatility and action has been over the last year. And most of it is because the market and the Fed have been completely out of sync with what's being said. The Fed, as we alluded to earlier, they're going to continue to talk tough about inflation. They're going to continue to talk tough about staying higher for longer until the inflation genie is back in its 2% target bottle. And as we've already said, it's nowhere near that level. And there's signs it's easing, but not enough. And so this will be a point for the rest of the year of seeing, is the market right or is the Fed right?
So this is, we talked about present value calculations and valuations earlier. And what this slide is, illuminating is that when interest rates rise, values compress. And you think about it, when you do like a discounted cash flow model, the higher the rate, the lower the value. So present value thought process we learned in high school and college, I've forgotten, it's been 30 plus years for me. But the point being is this makes sense, meaning everything prices off a 10-year treasury. So as rates go higher, all other asset classes will compress.
Yeah, and this is really a summary of what Mark was said. Normally, the average really over many decades in terms of a price to earnings ratio of the S&P has been about 15. And we were really, really elevated at the peak of COVID for a lot of reasons, which we will spare you today. It compressed a lot during 2022, but it's still above average. And there is potential for further erosion of that multiple.
So what we're getting at is things weaken. Analyst estimates do not reflect a contraction in earnings. And we're giving you some color, the last two downsides, what happened to earnings. And when earnings denigrate, stock prices denigrate as well. So we're, basically above on the forward multiple basis, we're above the average by quite some. And today, earning estimates are down 4% from recent highs. So unfortunately, if we do slow down, we should expect a further earnings denigration from here.
And then this graph, this is a little bit of an explanation of what happened last year. I think it's a good color in that the white bar on top is more value type stocks. So think energy companies. And the graph on the bottom is growth stocks, think technology. And you can really see the earnings revisions, maybe not surprising. You've seen pretty strong holding and even rising for the value components of the S&P 500, but the big declines of technology companies in terms of their growth rates going forward and their earnings revisions. That's actually pretty similar to how the markets performed last year. Last year we saw very strong outperformance by value stocks relative to growth stocks. Of course, that followed many years of growth stock outperformance, but that eventually stocks follow earnings. So we are paying very close attention to it. And it does tend to be a good indicator over time.
And we'll shift gears and talk about new opportunities, as we look forward. And what Matt was alluding to in terms of valuation, growth stocks really leading the way. Our markets are a little different than global developed markets. We have a much larger allocation to technology, and technology trades at a much higher multiple. So the last decade was a multiple that was led by multiple expansion and Fed policy, which was easy money and low interest rates. The next decade will be very different. And when you go through bear markets, you generally have a shift in leadership. And for the last 15 months, internationally developed markets have outperformed the US. And it's in concert with the dollar, which rose to an all-time high, has started to denigrate. And so we're suggesting taking a hard look at developed market stocks outside of the US. Go ahead.
Yeah, high quality fixed income. And when we say this, we mean primarily treasuries at this point. As we said, I think that graph we showed on bank deposits versus money markets, that's the same kind of graph as treasuries. We're closer to 5% in short duration treasuries right now. That's the first time in Mark and my careers that we've really been almost excited about buying treasuries because they do present that type of opportunity.
Go ahead, you can take direct. I'm going to add to it.
Okay, direct lending. So the next two bullet points, direct lending and secondary private equity, these are private investments, generally speaking, not necessarily for all investors, but they offer unique risk reward. You're paid for the illiquidity. On the direct lending side, essentially, they did really well last year despite a 13% down bond market because they have a floating rate component to them. They also happen to sit atop the capital structure and have a lot of security below them. So you're getting what we think is equity-like returns, but with a whole lot less volatility. You want to talk about a second?
Yeah, no, I'll talk about, let me continue on direct lending and kind of give you our team's views. We think, capital structures are going to adjust from a zero interest rate to reality, which is going to shift from kind of equity to debt. And so the opportunity set in credit is much more desirable than equity as we move forward. And so the way our team's expressing that view is in direct lending.
Yeah. And then secondary private equity, we're going to talk a little bit more about both these in a second. So just a high level, it's an opportunity set right now, which is beyond ripe with forced sellers. And broadly speaking, what this is large institutions that have investor policy statements and are kind of forced into certain ranges of allocations. If you think about what happened last year, the bond market was down 13% and change. The equity markets were down high teens. And private markets largely held up, particularly real estate and certain other areas of privates. So in order to get their investor policy statements back in line, they need to basically sell in the private markets. That's what secondary private equity is. They're the buyers. They're the providers of liquidity for those large institutions to be able to readjust their investor policy statements. And then the distressed debt, something we're watching, knowing that we might have a recession on the horizon. There will be companies that are over leveraged, and our goal here is to buy good companies with bad balance sheets and buy the debt at discounted prices and wait. But we're kind of watching that one as a possible investment as we go through the rest of this year.
So let's unpack international stocks and give you some color. As I said before, the last 15 months, developed markets outside the U.S. have outperformed U.S. markets. And you can see from this graph, the 1 year, the 6 month, the year to date. And when these trends occur, it's not for 3 months, 6 months, or 18 months. These generally go on for 5 to 7 years. So just by way of rethinking maybe some allocations and thinking about allocating outside of the U.S.
Yeah, and a lot of it is driven by the incredible volatility of the dollar over the last year and change. And you can see this is the graph of the dollar index, which does have British pounds, yen, and a couple other currencies in this, and euro, obviously. You can see last year it got as high as 115. It has eased substantially. And I think some of this, if you think about it from the perspective, if you're a U.S. multinational company, and the dollar is very strong, it becomes harder for other countries to buy our goods and services. So we want kind of stability. We want to make it easy to budget, and this could be a tailwind for international stocks as well.
And this graph is just showing you the standard deviations of value and how much international stocks are so much cheaper than their U.S. counterparts, and it's roughly 2 standard deviations of valuation mismatch. So what I would say about valuation is a horrible timing tool, but over time markets do mean revert and get back to norms. And so given how out of whack the scenario is, we expect outperformance by stocks outside of the US. The same is true on dividends. You can see that dividends outside of the US are substantially higher than US companies, and this we expect to mean revert as well.
This is just a good graph of where we are in terms of yields available now in different various asset classes, really around the world in terms of fixed income. Most of our focus right now still remains on treasuries, and actually areas like high yield, which we'll touch on a little bit more in a second. We think that it's still a little early for many of those spaces, but you can see the red versus the blue. This is where we were at the end of 2021. And here we are 15 months later, and the yields are appreciably higher than they were. One of the more dramatic increases over our investment careers. Yeah, and so high yield, this is a graph. The top line is high yield bonds, and the bottom is investment grade. And really, a stressed situation for high yield, you would see this top line here is 600. And what that means is 600 basis points, 6% above a comparable treasury, effectively. Under stressful times, you would see this get to 900. During the financial crisis, there were periods of time where this was well into the 1800, 1900 over. But we really are not at levels right now, which are indicating a lot of stress and probably not enough risk reward for really entering high yield in size. And similarly, investment grade credit is just really not much different than the norm where it typically would be. So we mentioned private credit before, direct lending. It's really a broad base, but those 5 bullet points there are really the critical points. You're getting a loan. You're basically lending to primarily private equity players who are trying to buy a company. In return, you're getting a floating rate, which provides protection against rising interest rates. Higher seniority in the capital. You're usually above the equity, which gives you security. There's covenants, which are often mean you are secured by some sort of asset base. A lot of this is because there's illiquidity. So the premium is because you can't go out and sell this immediately. And generally, we really like the low correlation. It fits in nicely to a broad portfolio because the correlation to public markets is pretty low.
And then just by way of history, when you look at this asset class, this is the Cliffwater Direct Lending Index. This is first lien senior secured credit. So you're at the top of the cap stack. Nobody's in front of you. And what you can see is, since 2005, it's been one down year, which is 6.5%. And even last year, the index is up 6.3. So it's an underinvested asset class. It's very attractive, and it grows in correlation with private equity. As private equity grows, this asset class will grow as well. The banks used to do this, but since 2008, they really got out of this business, and it's gone to, a shadow banking system where very, very large players and institutions really are heavily engaged in this business activity.
So, we touched on it before, secondary, the unique opportunity. Mark and I were actually in a presentation yesterday, which really highlighted this mismatch of supply and demand. You are seeing tremendous amounts of volume coming to market with the attempted reallocation from institutions to secondary funds by being buyers of it. Its volumes are up 4 times what they were 1 year ago, which there's not a lot of new private secondary funds, which obviously means the discounts. You're generally buying private equity at a pretty large discount. That discount, according to the group we were with yesterday, is roughly 82 cents on the dollar for reasonable quality. And I think for that reason, we really like this. You're immediately buying at a discount. You're buying funds later in their life cycle, so your cash flow back quicker, your turns are quicker. And I think that's a quick summary. Mark, anything else?
Yeah, I would say so. I think Matt alluded to it. There's no J curve in secondaries. And to give you some color, there's about 3.8 years of dry powder in primary private equity for opportunities. There's less than 1 year of dry powder for secondaries. So secondaries is a phenomenon. As regular private equity grows, secondary should keep up. And Matt really hit it. There are more Marius opportunities than capital And there's 7 or 8 players who play in this space, and it's kind of an oligopoly. Matt and I cannot start our own secondary private equity firm because you need to have relationships with many, many GPs, and that's generally how it works. And then just to give you some color to really understand that these large institutions that run their find investor policy statement are limited to how much private equity they have. And Matt also talked about private equity outperforming their public market counterparts, both in net income and revenue last year, with the exception of venture. And so you have a scenario where some of these pensions by law have to sell their private equity. So you have, and those same pensions want anonymity. And so there are a few select, 7 or 8 in the oligopoly, I call them, that get a show and are basically doing what Warren Buffett does well. They provide liquidity when nobody else will do it. So as things get worse, this is going to be a great asset class in the next 2 to 3 years, and we're very, very excited about it. There's a second phenomenon, because the first phenomenon we talked about was an LP who needs liquidity or to reallocate. The other phenomenon comes from the general partners themselves, where they have a fund that the life is ending. Let's say it's a 10-year life, and there's 3 or 4 trophy assets, and they'd like to do an extension fund. Many of their existing LPs will ride along with them, but for the ones that don't, the oligopoly makes the GPs roll their carry, add capital, and comes in along. And that's a very attractive area that really has, the genesis was around 2016 and growing rapidly. And again, a period of illiquidity, some of these GPs want to show some gains. And even though they know there's more gains coming, they're forced to engage in these types of activities. So we are, very enthusiastic about the space.
So I know we're pretty much up against time. Essentially, the Fed is hiking rates. It's reducing its balance sheet. It's causing tighter lending standards. These are all liquidity being withdrawn from the U.S. and really global system. And as a result, the investment opportunities are those which there's an opportunity internationally, we believe, high quality bonds, private strategies, as we mentioned, and we're, as we said, we're watching distressed debt as well.
So we'll give you 2 quotes, to kind of leave you with, and one is from Benjamin Graham. As you guys can see, it states the best way to measure your investing success is not by whether you're beating the market, but by whether you're putting in place a financial plan, a behavioral discipline that are likely to get you to where you want to go in the end. What matters isn't crossing the finish line first, but making sure you cross it.
And then I think the second and last quote, we realize we're talking about recession. That's not a happy thought. But that being said, Jamie Dimon in the annual letter on April 4th said, finally, when one talks about risk for too long, it begins to cloud your judgment. Looking ahead, the positives are huge. However events play out is likely 20 years from now, America's GDP will be more than twice the size it is today, and hundreds of millions of people around the world will have been lifted out of poverty. What we tried to do today is show you, there's some tough things in the global economy. Markets tend to look forward, and we try to think not in a period of 3 to 6 months, but in a period of 5 to 10 years. Many of you, especially in the private world, these strategies are decade-long strategies in some cases. So you got to kind of look past the noise as an investor a lot of times and think long-term, because as we know from Jamie Dimon's comment, Ben Graham, Warren Buffett, the long-term thinking is really the winning strategy. So
I'll leave you one last thought, and this is from Warren Buffett. You make all your money in bear markets. You just don't know it. So if you look at successful investors, they tend to step in while many of us wait to see what's going to happen. So with that, I'll turn this back over to Mike and Jill and see if there's any questions we can help address.
Thanks, guys. First of all, thank you for the commentary. That was awesome. And I will remind our listeners that we will be sharing the slides after the presentation. There is a lot of information and a lot of data, Mark and Matt, that you shared. We have not fielded any questions in the chat box, but I did want to raise one for you to respond to. And Matt, you kind of alluded to it. There's so much data, so much information here. Thinking about our audience, we've got, leaders of privately held businesses listening in, thinking about, what you've shared from a business standpoint, probably thinking about it from an investor standpoint too. Help us distinguish the signal from the noise. What are the key kind of takeaways or the key areas they should be focused on, thinking about and talking about with their constituents and advisors as we look ahead?
I mean, I can start. I think two things quickly come to mind here. And number one is, especially for business owners, keep an eye on margin. We know the expense pressures have been great in the last year, and managing the margin, we're going to see it in publicly traded companies for sure. We certainly see that type of focus for many companies. But the other thing is, this has not been a thing for much of my career, but you really got to manage your cash right now, in that most companies keep their cash at a bank and it's earning zero. And a good cash management program, we have brought in several clients, even in highly cash utilizing businesses where cash flow is being used. We've brought in several clients where we're just managing short-term treasury ladders for them, 7 months in duration, where something's constantly coming due. And it's raising the yield on cash that's sitting at the bank for many companies from 0 to 5%, or 0.5% to 5%. But there's options, and most CFOs really, and for most of their careers, it was earning zero, and we're very close to it. There is an opportunity to make a little bit of extra cash flow right now on your cash, which is something probably new. Mark, anything?
Yeah, I would just say, Matt talking about margins, like it's shown is that people can raise prices and prices have stuck. So we really haven't seen margin compressions. So I think Matt hit it. I think the way to get through any crisis is making sure you have a good handle on your liquidity. And on the investing side, I think Matt also addressed, this is not your game plan wasn't for 6 months or a year. It was a long-term game plan, and chances are you're better off not making too many moves and adjusting your plan too, with too much change, because you may get out at the right time, but your chances are you won't get in back at the right time. Even if we look at the greater financial crisis, May of 2008, the market was at its high, and then it was a low March 9th, less than a year later, March 9th of 2009, and it really dramatically moved. So things have a way of moving much quicker, over the last several years than they used to. So I don't think, things will adjust pretty quickly, and then things will start to move. So I would say keep kind of a long-term focus. And right now in the short term for businesses, make sure you have adequate liquidity.
Awesome. Thank you. Jill, I'm not seeing any additional questions in the chat. Have you received any under private message?
No.
Okay.
Well, I'll just close. Thank you guys for the opportunity, and we're available if something comes up. And we hope everybody enjoys the rest of their Thursday and their weekend.
Thank you. Thanks to all of you for joining us today. We truly appreciate it, and we hope you enjoy the rest of your week. Take care.
Thanks, everyone. Have a nice afternoon.
Bye-bye.